Timchang Gwatau, a senior research analyst at Meristem, joins us now to discuss the outlook for the equities market, especially in the context of our expectations for the banking sector. Timchang, thank you so much for your time. If we start with the banking sector and just analyze some of the numbers that we have seen so far in terms of half-year numbers, it doesn't sound like a very positive picture. I wonder what's your perspective on what we've seen so far before we get to the results that we're expecting?
Okay, thank you, Wally, for having me. I mean, it would, just like you said, most of the big banks have not yet released their H1 numbers. So far, we've seen maybe 4 or 5 banks, but I mean, I wouldn't call the results we've seen so far impressive. What we've had, we've seen a sharper than expected contraction in interest income, for instance. I mean, there were lots of expectations, given where the banks were coming from last year. There were expectations, I mean, especially given the fact that the yield environment had shown signs of improvement as at the beginning of the year. I mean, so there were expectations. We had expectations that interest income was going to do a lot better than we have seen so far. So we've seen contractions as high as 24% and 5% for some of the banks, and of course, you know that constitutes the bulk of the earnings for banks. So far, I mean, based on that, I don't think we've seen very impressive performance. That has also flowed down to the bottom line. All right, so earnings have also contracted. Except, I mean, there have been one or two exceptions, maybe ETI and Wema Bank.
Right.
But other than that, I don't think that the performance of banks so far have been impressive. But I would add that again, we haven't seen for the big banks. The big banks, Zenith, Guarantee, they tend to be immune to some of the shocks that have impacted some of the smaller banks. So, for instance, there were sustained CRR debits in H1, and that tends to have a heavier impact on the banks we have seen so far. So hopefully, I mean, the expectation is that the bigger banks will have stronger performance, although I can't see that the outlook is so great for banks.
Okay, Timchang, I want to get your perspective on the outlook for the banking business fundamentally, because what we're seeing now is that the likes of GT Bank is now transiting to a holding company, and perhaps they are looking to tap into the type of success we've seen with the likes of Stanbic IBTC, which we know is quite diversified in terms of its earning base. Do you think that is the way to go for financial institutions moving forward, to have that diversity in their earnings base? Or do you think that the traditional banking business can still be a way forward for success?
I think that going forward, this diversified business will make a difference between banks that will remain sustainable. There are lots of opportunities in the financial space, and of course, there's a lot of boundaries that are falling. What I mean is that we have a lot of hybrid kinds of businesses now. Considering the kind of challenges that fintechs also pose, so I think that the banks need to have a diversified model in order to be able to withstand some of the shocks that they are facing at this time. So I think that the diversified business is the way to go. I mean, also when you consider the regulatory constraints that banks face, I mean, over the past 2 years, I know banks have come under very intense regulatory scrutiny. I don't think it hurts that if they reduce that risk on traditional banking model. But I mean, they don't have their opportunities, for instance, in payments, and other kinds of financial services. I mean, I really think that the way to go is to minimize your exposure to the traditional banking business and look for other ways to make money. And I think that GT Bank has taken the right step. I actually expect many more banks that have not taking these steps to follow through. So there's a lot more opportunity in the financial space that banks, given their current non-investment to make the difference, like I said earlier, between banks that will remain sustainable and banks that will not.
All right. Okay, let's talk a bit about what to expect from those that haven't reported. You mentioned GT Bank, for example. We're also expecting numbers from Access Bank, even though we are told that may not be published until perhaps mid-September. What can we anticipate from those big banks that typically deliver interim dividends?
frankly, I mean, I don't think that we can expect any dramatic increase in performance. I mean, so I'm seeing dramatic because of some of the results we've seen so far from other sectors. You know that for some other sectors, they were highly impacted by COVID. You know, and so some of the numbers we're seeing from saying the construction, the companies in the construction sector, the consumer goods, and all of that. I mean, you see them posting very significant growth in top line and bottom line. I don't think that we can expect that kind of performance for banks. For one, the performance wasn't that bad in H1 last year, so I don't think that they're coming from a very low base point, right? So you have that, and then you also have, as I mentioned earlier, the constraints on interest income, which is the key sort of revenue for the banks and also for earnings. So I mean, I really don't think that. I'm not very optimistic about the results coming that we can expect from Access Bank, GT Bank, and the other big banks. Although some of them have announced plans to pay dividends. I mean, I would expect that Zenith Bank will be so fine. I think that I'll keep my expectations that given the constraints we've seen for interest income. I would also want to speak to the trading gains, for instance. So of course, no one expected trading gains to be so significant this year, given the reverse in the yield environment, right? So trading gains have declined as expected. However, I think the upside, the aspect of the business that we're quite bullish about is fees and commission income. I mean, we've seen very strong numbers so far in terms of transaction volumes, and that is one aspect of the business that we can point to. I mean, as having potential to drive strong growth in H1 and going forward. So, but I mean, in terms of overall performance, I think I'll keep it at best.
Okay, very quick comment on the outlook for the market. So you've spoken to the outlook for in terms of earnings for the banks. How does that translate to performance at the bourse? Because we've seen the bourse do pretty well over the last few weeks.
Yeah. So, I mean, if you look at the performance of the NGX and ESI so far, I think that perhaps if you look at it from Q1, we've had the sentiment has been progressively positive. So we've had I mean, not very good Q1, and then a better Q2, and of course a much better Q3. I don't think that anyone should be surprised by the performance we've seen so far in Q3. Like I said, the expectations for earnings was strong, right? I mean, investors had expected strong performance from some of these companies. That's one of the things driving the positive sentiment we've seen so far in Q3 for the equities market. I think I also want to add that, I mean, we've also seen the diversification away from some of the companies we were used to. So you're beginning to see very strange tickers. Well, not so strange, but of course, they're not the tickers we're used to. Tickers like Pharma.
All right, Timchang.
And all of that, you know. So I think that the sentiment
I apologize. I really have to interject there because we are running out of time. Thank you so much for your insight. Timchang Gwatau is a senior research analyst at Meristem Securities.